All right. Good morning. Good morning, everybody. So we got day 2 of Powell. If you thought yesterday was a circus, you haven't seen anything yet. That was consider that the grown-up approach, as pathetic as that is. Today's going to be the Children's Day. So when he's up there, instead of talking about banking policy and regulations, they're very likely going to be trying to do all the gotcha stuff and get him to admit the crazy things, pick a fight, stomp his feet and say he can't be fired, and all the other wedges that they're going to try to put into it. If he's going to be misquoted or in some way taken out of context, it would be today. He is, of course, going to try to play Operation Don't Rock the Boat and just talk out of both sides of his mouth without really saying anything, trying to avoid all the landmines. We'll see if he can do it. We also have the opportunity for a liquidity gap this morning when we have economic data coming in. So we look what's going on around the world. We got the small caps up 0.25%, NASDAQ, S&P basically flat. Hong Kong also, everybody's just waiting on this data. So we've got Powell, then Williams and Bosick. We're going to get some data on the monthly budget, and late tonight or later, we'll have Waller. All of that on top of the CPI, which is where we could get a gap this morning. Now, if you look at the numbers, they're not really out of line. That's one thing that you can try to do when preparing for the economic event of the day, is check to see if there's any consensus numbers that are way off estimate. That doesn't guarantee that there won't be a big move, but when you're looking around, if you notice that the consensus or the probability is that there's going to be a big number difference, then that generally means that there's some differences of opinion on what they think we're going to get, and then we're likely to see more violence. We got the 10-year auction today. I mean, you're not supposed to have favorites, but that is one that I pay particular attention to. Watch the clock, 1 o'clock today, and that'll just get stacked on with everything else and everybody else who's talking today. It's going to be a busy one. So a discussion on this gap close. These setups can happen on the intraday, which is what we're looking at here, but really we get these all over the place. When we get the data this morning, we want one single candle in one direction. We don't want one candle with a bunch of wicks. Notice the way this one started, there wasn't really much wick to the upside. It just went down. It closed in the lower portion. It didn't pull back and leave a big wick behind. You got the gap closed around 11 o'clock. Now here's another example, almost no wick to start it out. And it did pull back, but if you break this candle down into quarters, then it's in the upper 3/4 area. You can see why we don't want one of those wicks, because we got stuck in it before we were able to finally get out. Consolidation, a move back to get the gap around 11 o'clock. Another example, but it didn't really consolidate or base after it was built. We got up there, immediately we started working on the gap close, got back about 10:30. So showing examples of what we're looking for, I think it's useful, so you have an idea of what it's supposed to look like. But I do like to throw in what we do not want, because it kind of helps with questions when people say, well, what about this one? Does this count? This is not what we're looking for. You get a candle like this today, there is no gap close to play, right? And I get it. You don't see a gap in the first place, but it's a liquidity gap. So if you think about where this candle opened, and then where it closed, it was so close to being back to where it started, there really wasn't anywhere for it to go, and it immediately got the gap closed. But if we measured that one big bar on a 5-minute and we project that higher, then 50% will be a stopping point and 100% will be a stopping point. We can also measure this candle, mark its midpoint, and if we come back later to test it, that midpoint will be a stopping point. So even if you don't want to trade the gap close, you can use that candle. Even if it's a big solid print candle like I was showing earlier, you can measure that and plot it upside, downside, no matter which direction we go. It's half back, should provide a stopping point, and so will the extension or the measured move into 111, 1236. Just get as much out of that candle as you can, right? So here's another one, 830 print, big candle. I put it in a cloud just to be able to see it, but that half back, the extension, even the 111 on the other side in an extension, all came from this one candle today that we're going to get, that 830 candle. Now, it is possible at 830 that we just don't get a big candle. I find that, highly unlikely, but price can do whatever it wants. So, just kind of keep in mind, while we are expecting a big move, it doesn't have to. And while all the examples today don't show a big move with a continuation, that can happen. So, if we just kind of come back to one of these that worked, we can get a big move and then it just keeps on going. It does not have to come back and close this gap, at least not today. So while I don't have an example of that, it is possible. We've got the volatility trigger and VWAP pretty much at our feet. We're above the 10 and the 3-week, the 20-day, zero gamma, which the zero gamma has been taken down considerably. And I didn't see them mention that in the spot gamma notes this morning, but I consider that a bit bullish in the behavior. And the spot gamma note, they called out taking long calls yesterday just because of how cheap they are, looking for some right side exposure. And that kind of ties in with this move for this drop down in zero gamma, at least to me. They didn't lay it out that way in their notes, but I do consider this a bullish outcome. Now, whether it stays down there, so remember, we can get a false reading for one day. One of these lines can get moved and then we see it shift back again by the next day. Let's see if it's still there by tomorrow. But if it has now relocated down into that 60-58 area, that's going to be pretty good. I think we'll like that. Volume's a little light at 40. The idea behind that light volume is if we didn't know there was some economic events today and we've seen volume that light, we'd want to go looking around and try to find out, why is the volume so light? Maybe there's a place that's closed for holidays, or maybe there's an economic event on the table that snuck past us and it's just under the radar. But that's the idea of looking at the overnight volume, is to kind of have an idea of, what are they doing right now? They sitting out and waiting? Are they hedging? Did they even show up today? So this low number isn't a surprise because we have CPI this morning and they are hedging into this event. Now, don't get me wrong, they're always hedged, always. This is extra hedging, kind of like when, they're calling for hurricanes to hit in the next 4 days and you call your insurance broker and you get extra hurricane insurance on your house. Why not, right? You got one coming at you, you might as well double down. When these guys put on hedges, it's nothing but cost. It's not like retail traders where we could potentially just use them for profit trades. It's all cost for them. If the hedge pays them, it won't make them whole. It'll just help with the losses. Otherwise, just buying the hedge is cost. So when they do it, it's because they really need it, or they think they really need it, because they're worried about some economic event. This morning, they're worried about CPI. But after 8:30, when we get CPI, watch that number to see if it begins to shrink. If it does, then they're satisfied with CPI, and that'll be the end of it. But if it stays elevated or gets bigger after 8:30, pay attention to Powell, because he would be the next biggest threat on the day, and it'd be the other reason that they're hedging. They're not hedging because of Powell. I'm pretty confident about that. But if they leave it on, then that'll be because at that point they're worried, because that can tie in with what number we get today at 8:30 and why it might make them nervous about Powell. We're holding above the weekly pivot reasonably well, but I mean, all we're doing is holding sideways as we have Powell up on the hill. So we're just keeping our distance, basically sitting inside of Friday's candle and not really doing much of anything. Today's floor pivot is higher than yesterday. That's considered bullish. Price opened above that pivot. It's also considered bullish. We've hit the pivot, so it's not an MDP. We don't have a missed pivot that we need to go get. And at this point, we'd want to open up those floor pivots and look at the S&R lines to see if they're going to get in our way. Now that we've had a couple of days of sideways, the S&R lines are going to be a lot closer to us now that we've stayed in this tight range. Yeah, doesn't take much to hit one of the S&R lines today. 6106 on the upside and 6065 to the downside. If we were to zoom out and look at this from a few days ago, you can see some of these others that were a lot wider, right? Price this day, back on February 5, is the same spot as where price is today. And yet look at how wide the range is compared to what we have now. So if you're using floor pivots with S&R levels, just continue to focus on the idea that you got to ask, how close are my S&R lines compared to what they normally have been? John Person built a lot of tools that focus on this. He's got his Person's pivots and the PPM indicator. There's like 4 things that Thinkorswim has that are all John Person's tools. And one of them is a tool that measures this distance on a day-to-day basis to see, what's the trend doing? Is it shrinking down or is it expanding? Kind of gives you some insight. If you use floor pivots and the S&R frequently, probably want to check out John Person. All right, looking at what we've done for the week, since we haven't really gone anywhere and we haven't really done anything, we've got a really tight distribution. Narrow range, tight distribution. We're just building up a space here that when we finally leave this range, if we leave to the downside, this will become a significant resistance level. And if we leave to the upside, then it should act as a significant support level once we get away from it. Until then, we can just cross back and forth through this zone, building it up more and more. And it's about a 25-point zone from 6,100 down to 60.75. But if you wanted to stretch it, you could make it 50 points down to 60.50. This is likely going to become a significant level going forward. Any break to the upside doesn't really have much looking back that we have to deal with. Got a high volume note around the round number, but that's not a surprise. And 60.32 cog line. I mean, it's always possible. You know, I remember that mic drop moment that he did in Jackson Hole. I think that's been the classic back when they were still raising rates. And he turned a 15 or 20-minute speech into a 2-minute speech that pretty much said, you know, we're going to keep it higher and longer. So, you know, get used to it, something like that. And he just dropped the mic and that was it. Man, the markets freaked out that day. 10-day, 30-minute volume profile with TPO. They're lined up. We're not expecting a significant change here anytime soon. 60.92 right on the cog line. And there's really nowhere for this thing to go. So, you know, talking about building out a significant level. Yeah. Now we've certainly done that. The range here, 6,100 down to 60.50. Like we were talking about, it's a big zone. So we can wick back and forth through this as much as we want. But if we leave the range and come back, it's very likely going to be supportive or resistive, depending on which way we went. I think I lean in with Spot Gamma on this one, on the idea that when we finally break out, and this thing isn't projecting direction, but when we do break out, looking at everything we've got so far, I'd lean to the upside. There's certainly, go look at the options. Calls are certainly pricing in that the market is thinking the same thing. No VPOC from yesterday, another sideways day, point of control. We've been cutting through it. There's nothing to carry forward for me. The textbooks would tell you to carry forward the value area high and low and the point of control. And I mean, sure, if you did that, it looks like we came down near that value area low, but I don't carry those forward. We got nothing yet, which is not a surprise. We're just waiting on Powell and CPI. Still holding the week, still holding within Monday's range. You could consider that Monday is the boss at this point. Focus on the mid. So high, low, and mid. 60.55 would be that breakdown point. And we are IX10 at this point, but when you're IX10 inside of a really wide range, it kind of loses its impact. At this point, we're inside day of yesterday, and that was a much narrower range. So, you know, we can expect that when we do get out of this range, that there's going to be violence. If we can get one more day first in this compressed structure, I think the move out of it would be a lot better, but I don't think we're going to get it. Don't forget, next week's a short week with a holiday on President's Day. So that's going to mess with our weekly expected move next week. We're still above the 10-day, but really we're just at the 10-day, and we can cross back and forth above and below that 10-day. It's not really going to be valuable one way or the other. We need to leave this range and then come back to it. So from the daily, not much insight. On the weekly, we're around that 1% area. So we're just on the edge of the escape zone. We really need to get out of that one and start getting into like 1.5%, 2% away from the 10-week so that we don't get drawn back into it. Otherwise, 1%, it's a good start. We can't stay here. So we got to continue this drive or we're going to fade back. VIX is down. China's up. Bitcoin. And really that is all we've got is China and Bitcoin this morning. If we're using 0.5%, then that's all we've got. Yeah, we don't even have like pot stocks, solar, nothing. China and Bitcoin. So that's what we would be looking for to change today. Get done with Powell. Start to see a difference between growth and value. Get the Mag 7 in line, some chips moving. That can give us a breakout day. Or after the market is open, keep your eye on the options. If we start getting a lot of options flow, that can get us out today. But it's got to be something, right? Because we don't have the backdrop of the market to do the work. Not yet. Keep your eye on those like a market breadth tool. You need consumer discretionary, financials, technology, communications, software. Don't want to rally based on pot stocks and solar. That's not going to do it. So short and sweet, pretty easy. Watch the Powell remarks, wait for him to finish, get through this gap close. Dodge the speakers. We got them coming through all day. Gotta be careful. I'll see you tomorrow.